This video is going to be over fair value gaps. What is a fair value gap? What is a BISI? What is a SIBI? What is consequent encroachment, as well as inversion? We will also touch on the difference between a fair value gap and a volume imbalance. So, let's get into it. The first thing we are going to go over is what a fair value gap actually is. A fair value gap is a three-candlestick pattern. Specifically, it forms when the low of the first candle does not overlap with the high of the third candle, or when the high of the first candle does not overlap with the low of the third candle. Let's break that down more clearly. Imagine we take the low of the first candle and extend it forward. Then we take the high of the third candle and extend it backward. If those two levels do not overlap, there is a gap between them. That space in between is the fair value gap. In a bullish example, the first candle's high does not overlap with the third candle's low. That means price moved so aggressively in one direction that it left an imbalance between those candles. That imbalance is what we call the fair value gap. Now let's look at what is not a fair value gap. If we extend the low of the first candle and the high of the third candle, and they overlap, then there is no gap. If the low of the first candle is below or inside the range of the third candle's high, that means price traded through that area. There is no imbalance. Therefore, it is not a fair value gap. The same applies in the opposite direction. If the high of the first candle overlaps with the low of the third candle, there is no gap. No imbalance was left behind. So to simplify it, if there is clear separation between the first and third candle, that creates a fair value gap. If there is overlap between the first and third candle, there is no fair value gap. That space between them represents inefficiency in price delivery, and that is what we look to trade. Now that you understand exactly what a fair value gap is and what it is not, let's go over a few chart examples and see how they form in real market conditions. So if you look right here, we take the first candle's low and extend it out. Then we take the third candle's high and extend that out as well. You can clearly see there is a gap between the first candle's low and the third candle's high. That separation is what creates the fair value gap. Now if you look closely, do we have another one? Yes, we do. Again, the low of this candle does not overlap with the high of the third candle. There is clear separation between those levels, which means another imbalance has formed. That is another fair value gap. Now price makes an aggressive move in the opposite direction. And if we focus on this next three candle sequence, 1, 2, 3, you can see that the high of the first candle does not overlap with the low of the third candle. That creates a bearish fair value gap. So whether bullish or bearish, the logic is the same. If the first and third candles do not overlap, that imbalance between them is your fair value gap. The next thing we are going to go over are CEBs and BECs. A CEB stands for sell-side imbalance, buy-side inefficiency. What that means is that aggressive selling occurred, but there was not enough buying on the opposite side to keep price balanced. Because of that, price moved quickly and left an inefficiency behind. In simple terms, a SIBI is just a bearish fair value gap. On the other hand, a BCE stands for buy-side imbalance, sell-side inefficiency. That means aggressive buying occurred, but there was not enough selling to properly balance price. So price displaced higher and left an inefficiency behind. In simple terms, a BCE is a bullish fair value gap, so you do not need to overcomplicate it. A CEB is a bearish imbalance. A BC is a bullish imbalance. They are simply different names describing the same concept of fair value gaps, just from the perspective of which side of the market was aggressive. So if we look at this price section right here, we can see a bearish fair value gap form. In this case, sell-side imbalance occurred and buy-side inefficiency was present. There was aggressive selling, but not enough buying to properly rebalance price. That creates a sell-side imbalance, buy-side inefficiency, which is simply a bearish fair value gap. Now if we move over here and let price play out, you can see that we form a bullish fair value gap. This time, buy-side imbalance occurred and sell-side inefficiency was present. There was aggressive buying, but not enough selling to balance the move. That creates a buy-side imbalance, sell-side inefficiency, which is just a bullish fair value gap. So right there you have a clean example of both a sell-side imbalance, buy-side inefficiency, and a buy-side imbalance, sell-side inefficiency on the chart. One represents bearish imbalance, the other represents bullish imbalance. There are three main things that I focus on within a fair value gap. The first is the start of the fair value gap, which is the edge of the imbalance where price initially displaced from. The second is the consequent encroachment, which is the 50% level of the fair value gap. And the third is the full fill, which is when price completely trades through the entire gap, when price returns to a fair value gap. There are a few different reactions I look for. One possibility is that price trades into the fair value gap, respects it, closes, and then continues in the original direction. For example, in a bearish fair value gap, price may trade up into the gap, close, and then continue lower. Another possibility is that price trades specifically into the consequent encroachment, the 50% level of the fair value gap. From there, I generally want to see price close back outside of that level. As long as price is respecting the consequent encroachment and not closing decisively beyond it, I am relatively flexible with that reaction. A third scenario is that price trades into the fair value gap and forms another imbalance inside of it. In that case, I prefer to see price close back outside of the consequent encroachment before considering it a strong rejection. The key invalidation for me is the close. When price begins to close beyond the consequent encroachment or fully outside of the fair value gap, that tells me price is no longer respecting that imbalance. Once that happens, the probability of reversal decreases significantly, and many times price will continue through instead of reacting from it. So the start of the gap, the 50% level, and the full fill are the three areas I monitor. And the way price closes around those levels determines whether the fair value gap is being respected or invalidated. Going back to our previous example, we have a sell-side imbalance, buy-side inefficiency right here. Let's mark out the consequent encroachment, which is the 50% level of that fair value gap, and see how price reacts. You can see that when price trades back up into this fair value gap, it does not close above the consequent encroachment. That means price is respecting the imbalance. It reacts from that area and continues lower, which confirms that the fair value gap held. Now let's take a look at another sell-side imbalance, buy-side inefficiency right here. We mark out its consequent encroachment as well. In this case, price does not respect it at all. It trades through the fair value gap and closes clearly beyond the consequent encroachment. When that happens, I consider that fair value gap invalidated because price is no longer respecting the imbalance. Once we start closing beyond that midpoint decisively, the probability of reversal drops significantly. Now looking at this buy-side imbalance, sell-side inefficiency, let's mark out the consequent encroachment. As price trades into the fair value gap, it initially closes and shows some respect to that level. However, if we consider the overall range and its discount and premium, I would ideally like to see price trade slightly deeper into discount before expanding higher. As price continues, you can see that it taps into the consequent encroachment, closes outside of it, and then continues higher. That reaction confirms that the fair value gap was respected and used as a point of continuation. So again, the key element is how price behaves around the consequent encroachment and how it closes relative to that midpoint. That is what determines whether the fair value gap is valid or invalid. The next thing we are going to look at is fair value gap inversion. Fair value gap inversion happens when a fair value gap fails. In other words, price closes through it instead of respecting it. When that happens, the same fair value gap can later be used in the opposite way, acting as support or resistance. For example, if we have a sell-side imbalance, buy-side inefficiency, and price closes through it instead of reacting lower, that imbalance has failed. Now, if price later returns to that same area, I would expect it to potentially act as support and move away from it. On the other hand, if we have a buy-side imbalance, sell-side inefficiency, and price closes through it, invalidating it, that imbalance can later act as resistance. If price returns to that old area, I would expect it to reject from it and move away. One important thing to understand is that this does not need to happen immediately. The inversion does not have to occur right away or back to back. These fair value gaps also do not need to overlap. Price can close through an imbalance, consolidate for some time, and only later return to that same level. When it does, that previously failed fair value gap can then act as a new support or resistance level depending on the direction of the break. The last thing we are going to cover in this video is the difference between a fair value gap, a volume imbalance, and a true gap. We already discussed what defines a fair value gap. That is a 3-candle pattern where the first and third candles do not overlap, leaving an imbalance in price delivery. Now let's talk about a volume imbalance. A volume imbalance is different. It is a gap between the closing price of one candle and the opening price of the next candle. In other words, price opens significantly away from where the previous candle closed. However, unlike a true gap, there can still be overlap between the high and low of the candles. Trading still occurred in that overall range. The key difference between a volume imbalance and a true gap is this. A true gap is a complete absence of trading between two price levels. Price closes at one level and then opens at another level with no overlap at all, meaning there was no trading in between those prices. A volume imbalance, on the other hand, may show a separation between the close and the open, but there is still overlap between the high and low of the candles. So trading did occur in that range, it was just inefficient between those two specific prices. So to summarize, a fair value gap is a 3-candle imbalance within price delivery. A volume imbalance is a gap between the close of one candle and the open of the next, but with some overlap in overall range. A true gap is a complete absence of trading between two levels. Understanding the difference helps you correctly identify what type of inefficiency you are dealing with on the chart. All right, so that wraps up fair value gaps, volume imbalances, gap types, inversions, and everything we covered in this section. The key thing you need to understand is that fair value gaps represent imbalance in price delivery. Your job is not just to mark them, but to study how price reacts when it returns to them. Watch how it behaves around the consequent encroachment. Watch how it closes. Watch when it respects and when it fails. Also understand the difference between a fair value gap, a volume imbalance, and a true gap. They are not the same thing, and reading them correctly gives you better context. Now, the most important part is practice. Go into your charts, replay price, mark out the imbalances, and track how price reacts to them in different market conditions. If this helped you, make sure you like the video, subscribe to the channel, and share it with someone serious about improving their trading. I will see you in the next one.